So what is open interest? Open interest is basically total number of contracts formed between buyers and seller since the launch of the contract. And before we understand the open interest, we have to understand the volume also. Volume is basically the total number of trade happened in a period of time, say 1 day. So basically volume is on day-to-day basis. So a volume is for one particular day or a one particular time frame. Let's say in 5 minutes this much number of contracts traded, so that is the volume. For 1 hour trading you have a 1 hour volume. So likewise total number of trade happened in a time frame is the volume. Whereas the open interest is basically the contract formed between buyers and sellers since launch of the contract. So let's understand exactly what is open interest in trading volume. I'll give you an example for that. Let's say on 1st January there is a buyer who wants to buy a silver contract that is for, let's say, 50,000 rupee per kg. Okay, and there's a seller B who wants to sell the same contract. So the buyer A wants to buy a contract and the seller B wants to sell a contract. So basically open interest is into derivatives, not into the cash market where you take delivery. Okay, so the buyer A is ready to sign a contract to buy the silver for 50,000 and seller B is ready to sell the silver. Okay, so he's ready to sell the contract as a seller. So both makes a contract, so there's one open interest. And because only one trade happened between two parties A and B, so there was one trading volume. On 2nd January, there's a buyer C who comes into the picture and there's a seller D. They both again are creating a new contract. So what happens is the price increased from 50,000 to 51,000 and the open interest increased from 1 to 2. Why? Because one open interest was on the previous day and there's a new open interest opened. So there is a one more open interest. The previous day is 1 and today's 1, both together we sum it, it becomes 2, total number of open interest. Whereas the volume will still remain 1. Now let's look on the 3rd January. What happens is there are 2 new buyers and there's 2 new sellers. See, E and F are new, G and H is new. A and B and C, D all were new. Okay, they entered the market for the first time, they made the position for the first time. So E and F and G and H both again creates 2 more contract. So our open interest on the previous day was 2 and we have a new contract. We can say we have 2 new contracts. So this time the total open interest is 4. So what is happening here is all open interests are added. Every new open interest is added on a day-on-day basis. Whereas the volume came to 2 because on that particular day on 3rd January there were only 2 contracts were traded. Now let's understand on the 4th January. Now the B, the guy who sold first at 50,000, now the rate has increased to 53,000. So what happens is the rate has increased to 53,000. So in that situation this guy B is having losses. So he thinks to exit and he exits actually with a loss of 3,000 because he sold for 50,000, is buying for 53,000 higher than the selling price, it's incurring losses. The seller I, he is a new guy again. In this picture, in the previous picture, we have A was new and B was new, C was new and D was new, E and F were new and the G and H were new. Whereas the B and I transaction, B was an old seller and now he's becoming a buyer, so he's actually closing his position by selling and then buying. Whereas I is entering into a new contract. So eventually we can say that the B has actually transferred its contract to I. So in this situation, the open interest remains same. Why? Because one was closed and another was open. So open interest remains the same, but the trading volume is 1. On 5th January, we can say that the buyer is D and the seller is A. Now in this situation, both are old. Okay, so both are actually old buyers and sellers. So they had previous positions and now they want to scare it off. So in this situation, the D actually suffered a loss of almost 3,000, whereas A made a profit of 4,000. Now what happens? Both are old here. Both actually opened a contract. So there are two parties we need to open a contract, and two party again we need to close the contract. So we need two new parties actually to open and two old parties to close. Okay. So here D and A were old, so they closed the contract. Now we have a reduced open interest and the volume is 1 because trade took place as 1. Now on the 6th January, let's understand the rate actually increased to 55,000. Now in that situation, G and H is again actually having a loss of 3,000 each. Okay, whereas C and D, C was having actually a profit of 4,000 and E is actually having a profit of 3,000, and same F is also having a profit of 3,000. So what happens here is the total loss was almost 12,000, and I guess not 12,000, more than that. G, H and I. I is actually having a loss of 2,000. So 14,000 loss and 14,000 profit. So actually this market is really rude, or you can say crude, whatever it is. Once money is actually transferred into another's hand, so there's no value addition. Okay, so what happens here is open interest is basically the number of contracts opened and closed. So when we are trading in derivatives, okay, future options, forwards, future swaps, anything, okay, so we normally keep track of the open interest rather the volume. Volume you can see, but volume is more effective in the cash segment, or you can say the delivery segment, where you pay in full and take the delivery. The volume is good there, whereas in derivatives we normally see the open interest. What happens is when we are trading in derivatives, we use open interest. Also, you have to understand one thing, that the open interest actually signifies the liquidity in the market. Okay, and also the trading volume does the same thing. But when we talk about the derivative contract, there's the open interest which will tell you the liquidity, whereas and in cash market the volume will tell you the liquidity. Okay. Now how do we actually value future contract? Now as we know one thing, that normally in stocks or commodities you can have 1 month, 2 month, 3 month contracts, maybe up to an year or maybe up to 2 years. Sometimes you have 3-4 years contracts also available on the exchange. So how these future contracts are actually priced? Okay. Now, so you'll say, what do you mean by priced? Priced is exactly, let's say the gold is trading at 24,000. If you pay the full amount you buy from the spot market, so the future price will be different than the spot price, or it will be the same. Basically the future price will be different than the current market price if you pay in full. So understand first what is spot market. Spot market is basically where you pay in full and collect the underlying. So you pay in full and collect the underlying. That's the spot market. So that means you go to jewelers, you pay for gold, you take the gold biscuit home, that is spot price. You go to share market, stock exchange online, you log into your account, you pay in full and you buy the stocks, that is the spot price of the stock, the current market price trading at the time. Whereas the future price, future contracts, or the future contract price is little normally higher than the normally it is higher than the spot price, current market price. Why? Because it has the opportunity cost. Okay, what do you mean by the opportunity cost? I give you an example. Let's say I tell you to this, dear, I want to buy a house. Say, okay, ready. So how much will be the price? $1 million. So, dear, I want to buy it in, let's say, after 1 year. So then you'll say, boss, no, after 1 year it's quite possible the price will increase because the market is rising. And then I'll argue, no, price will not increase. I think the price will actually reduce. So both have valid points. But then the seller says, boss, if I deposit that $1 million into bank, the bank will give me certain interest over that. So I'll lose that. That's an opportunity cost. So what happens is, when we are doing a future contract, I'm holding the underlying asset with me. For who? For you. So that's why I need some interest over that. So that future contracts involve certain interest. Now how do we calculate it? There are two ways. Either you calculate it on a simple interest basis. So that is basically the principal, the rate of interest, and the time. Okay, so this is the value for your future contract. But this will only happen when the contract is done today and it cannot be exercised, okay, in between the contract periods. It will be only exercised at the time of expiry. Expiry means, let's say you do a contract today, 1st January, and the 31st December is the delivery date. The 31st December is your expiry of the contract. Okay, so in that situation you do the simple interest computing. Now whereas when you can buy and sell contract any day, so if you want to hold it for 1 month, 2 months, 3 months, or you want to hold it for 1 day, 2 day, or 3 day. So if you want to buy today, sell tomorrow. So why you gonna pay the interest for the entire year? So you have to pay the interest for only particular one single day. So in that situation, you have the future contracts because these are traded over the exchange. You can buy today, sell tomorrow, buy today, sell in next 5 minutes. So kind of thing is there. So you don't have to hold for the entire months. So the argument is that if I buy today and hold it for 5 days, so I should pay the interest only for the 5 days. Okay, the charges should be like 5 days. So for a 1 month contract, let's say I want to buy 1 month contract, I should pay the interest for 1 month contract. But because I can exit every day, so the interest is actually calculated on a compounding basis, a daily or you compounding basis, or you can say a continuous compounding basis, because you can exit or enter any day. So that's why it is daily compounding. So what is the formula for the future contract? So very simple. If you want to calculate for the stocks, it's simple. It's a spot price into exponential to the power R into T. Very simple. Okay, so let's say, or else if you're trading in commodities, then you have to add the carriage cost and warehousing cost, and as well as the convenience yield. Now let's not go into calculating commodity future contract price, let's understand first the simple one, that is spot into exponential to the r power into t. So this is the way which will actually give you the value of future contract. So what I'll do is I'll plot this formula on an Excel sheet and we'll try to figure out the future price for a stock or maybe a commodity. So what I'll do is I'll open an Excel sheet. So I have an Excel sheet. I have already plotted the formula here. So let's zoom it. Now, so look at here. The spot price of, let's say, gold, or maybe say any commodity, take gold, okay, is here 24,000. So if you pay in full, you'll get 24,000 gold worth 10 gram, okay, in INR. That's the rate here, let's say. And the value, the default value of exponential is 2.718. Okay, this is by default. And the risk-free rate is, let's say, 9% or maybe 8%. That's currently in India, 8 or 9%. And the time till expiry is 30 days. So that means you are holding this contract for around 30 days before. You're buying this contract for 30 days before. Okay, so if you buy on 25th, you have to pay lesser interest because only there are 5 days remaining for the expiry of this contract for the delivery date. Whereas if you buy on 1st of January, it's quite possible, 1st of the month, it's quite possible that you have to pay higher interest rate for 30 days. So if you put the formula here, same, the spot into exponential, spot into exponential to the power r into t. We can see the formula here and the time frame. So this is D7 divided by 365 days. So we get, hold on for a second. So I was telling that the theoretical value of the future contract is 24,178. So why this came? Because we were holding this contract, or we bought this contract about 30 days before. So if you buy on let's say 25 days before or 10 days before the expiry, in that situation you have to pay less interest. So the difference, or you can say the interest cost, will be very less into the future contract. So normally what do we understand by this formula? As if we go to the expiry, the difference between spot and future will be almost zero. Okay, why? Just see here, the spot price on 1st January was 24,000, whereas the theoretical value was 24,078. On 25th January, the price increased. On 3rd also it's increased. And on 15th, you have again a decreased price, then you have decreased price, again you have a more decreased price. So this is the spot price running, and based on the formula, we're calculating, because the day is zero, there is no interest. So what happens is, there are 3 situations. Okay, one is called Contango. Okay, so what does it mean by Contango? So in Contango, normally the forward contract price is greater than the spot price. This is a normal case. Then we have something called backwardation, whereas the forward contract price is lesser than the spot price. And then at the time of expiry, we normally have forwards equal to spot. We'll say why this forward equals to spot. One reason was there is no interest charge. We'll say, well, how about demand and supply? It's quite possible the buyer will be more and the sellers will be less. So it's quite possible the spot will be different than the futures. Let's see, if we have more demand into spot and we have less demand into futures, then the price will be different. First of all, we have to understand one thing. The future price is derived from an underlying asset. That is the spot price of the underlying asset. Second thing, let's say consider in the spot market the gold is trading at 24,000, whereas in the future market the gold is trading at 25,000. Now on the date of expiry, okay, so on the date of expiry there's a difference of 1,000. Now in that situation what will we do is we'll buy from here. So take the delivery from the spot market and close out a position by giving the delivery to the exchange. So what will happen? We make 1,000 rupee profit because it's the expiry time, expiry date. Same if the spot is less, let's say it is 25,000 and the forward is 24,000. In this situation what we will do is we buy here and we sell here. So we take the delivery here and supply it into the spot market. So this will give you, a kind of a arbitrage situation. So that's why on the date of expiry normally forwards are equal to spot. So based on the same thing, if there is huge difference between theoretical value and the actual value, okay, we can do a cash and carry arbitrage. This was done in the initial days of the stock markets. Now the market value is very much mature, so this is done less, but let's understand the concept. Now what is cash and carry arbitrage? What you have to do is, let's say consider if I want to do a cash and carry arbitrage, I'll buy, let's say I'll take a loan of 24,000 and then what I'll do is I'll buy the gold from the spot market. Okay, the spot market price we already know is, let's say 24,000 here on 1st January, and then at the same time we sell the future contract on the commodity exchange. Let's consider the commodity exchange future price was 24,000, whereas the actual theoretical value was 24,178. Okay, so this is the theoretical value based on the formula spot into exponential to the r power into t, whereas the actual trading figure was 24,500. So this is almost 1,000 rupees higher. And then what happens on 31st January? We sell the gold on 23,000. Let's say the market dropped. Okay, market went low from 24,000 to it went to 23,000. And then we also square off our gold position because spot and future will be same. There will be no gap because the spot meets what? Future. So what happens here is both are same. Now, so what will happen? The gold you bought in the market at 24,000, if you sell it at 23,000, it gives you a loss of 1,000. Whereas the gold you sold in future contract at 24,000, it actually 25,000. It actually gave you a profit of 2,000. Why? Because on the expiry 31st January, the future was trading at 23,000. So a profit of 2,000. So a loss from the spot market, whereas the profit from the future market, we make a profit of around net 1,000 rupees. But we also took a loan. So we have to pay the 1 month interest. That is, let's say at 9% per annum, it's 180 rupees. So after deducting the interest cost, we get 820 as the net profit. So this is your ROI. So this is called a cash and carry arbitrage. You take a loan. Now when do we do all this kind of thing? We only do when the actual trading price on the exchange, you can say the actual trading price on the exchange is mispriced. It's not matching the theoretical value. Let's say if you're getting 2%, if we talk about Indian standard, or let's say even you're getting 1.5%, more than 1%. you can execute the trade. So you can go into the trade, you execute the trade. Again, you'll definitely make around 1.5% or 2% a month. So if you're making it, you can go ahead. In this case, we also saw the theoretical value was 24,178, whereas the actual value on the market was 25,000. So in this situation, the gap was around 1,000 rupee. Now, how often does this mispricing happens? And I tell you, this is quite often. It's quite often. To figure out this kind of mispricing, there are arbitrage softwares. One of the very popular software in India is Omnisys, and another one is GreekSoft. Okay, you may also have many arbitrage software in your, exchange. Have to just find out what are the arbitrage softwares available, because there are many strategies. One strategy was cash and carry arbitrage, okay, where you see the mispricing of theoretical value and the actual value. Another one is from one contract to next month contract, okay, that is called a calendar arbitrage, because we know that there's 1 month contract, then we have 2 months contract, then we have 3 months contract, and it's quite possible these contracts are mispriced. So you have too long a contract of current month and quite possible shorter contract of the next month, whichever is higher or low. Okay, then there you have the trading on spreads. Okay, these spreads become sometimes low, sometimes become very wide. I tell you, sometimes the spreads are more than 3-4%, okay, which is huge, and you can easily get benefited from those spreads. Okay, and these softwares like Omnisys, GreekSoft, how they do help you is they have some kind of screeners, and let's say out of 200 commodities, they'll figure out in what commodities what kind of arbitrage is possible, and you simply have to press the button go ahead, and they'll take the order. It's a kind of automated trading that it's very effective. In the initial days, let's say they started in 2010. In 2010, there are many flaws. Nowadays, the flaws are less. Now, what is happening is, in these kind of situations, there are mispricings, but there are plenty of arbitrage companies who are investing crores, okay, $1 million into this kind of business. Everybody is having the same softwares, and everybody is having servers. What happens is, now, my software will file the same thing, your software will find the same thing. So whoever enters the first wins the race. But then again, who is connected very fast to the server? So I'll say I have a lease line. So you say I too have a lease line. So I have my server directly connected to the exchange. So let's say the exchange in Georgia, and I'll be also sitting in Georgia. We have exchange in Mumbai, so I'll open an office in Mumbai. So I won't be doing it from Delhi. It's 3,000 kilometers. Whereas same in Mumbai, it's hardly next building. So if I press enter first, I'll be punching the order before you. Now, then what happens? I also open my office in Mumbai. Then what will happen? So see, I have a slot in the server. So I have a rack there. I have a half rack. So I too have a half rack. I have a full rack. I have a full rack. Now the situation is that it's becoming a high frequency trading. Instead of going about the arbitrage, see how fast you enter the trade, because everybody is having the software. My conclusion is that if you actually want to do arbitrage into commodities, rather doing on the same exchange, you do a cross-country arbitrage. Cross-country arbitrage now are selling like hotcake, and very profitable. Why? Because there are mispricing in LME and MC. The huge mispricing, huge. Sometimes before I saw mispricing around 2,000 rupees. Okay, in let's say LME and the MCX. One day I saw around 3,000. So that means almost a mispricing of 10%. Can you imagine 10% mispricing between two exchanges? So you'll say the currency conversion rate, how about that? Come on, if you want to take the currency risk, just hedge your currency risk and you can make good amount of returns. Okay, and people are doing it. People are doing it in the market. What they're doing is they're opening an LP, limited liability partnership, into your country, and then operating from there, and they're also taking a trade here. So what they're doing is they're buying in your contract. Let's say in LME the trading is happening at 24,000. Let's say convert into INR. In India that's happening at 27,000. So what I do is I buy cheap, okay, and I sell here. So on the time of expiry, I see both the matches. If do not match, I take the delivery here, and I supply here. Very simple. And after cutting the carriage cost, I am definitely left with 3, 4, or 5% margin. 3-4% margin. So 3-4% every month on a continuous basis is great. Okay, so that is an inter-country arbitrage. Very simple, very simple. You just have to have technology setup. A little bit amount of money. Then that's how we understand the future pricing, and then we understood so how the marking to market is being done. It's called M to M. Let's understand. I bought a contract. I'll go simple way. I won't go complicated way. So on 1st January, I actually bought a contract. Let's say I bought a contract for silver, and the price for that, the current market price for that was 25. Let's say 30,000. Keep it simple, 30,000, and the lot size was, let's say, 5 kgs. So the total value will be how much? The total value will be 1.5 or 150,000. And then if I have to deposit the margin, let's say the margin amount was 10%. So to buy the slot, I just have to pay 15,000. Okay, and my account balance was, let's say, left with 0. So I'm not keeping anything extra. Now, condition 1 is that on 2nd January, the rate reduced. Bad luck. It went to 29,000. So you had 5 lots, 5 kg lot. So the total value was around 14500. Okay, and the margin required was 14,500. So you're given actually 500 rupees as extra margin. However, you faced a loss of 1,000 per kg. So 5 kgs, you had a loss of 5,000. So in your account will be debited with 5,000. So, but I don't have my account balance of 5,000. I have 0 here. Now, so what will happen is they will reduce this 5,000 from my account. So if I had 15,000, I'll reduce 5,000. So the account is left with only how much? 10,000. Now, whereas the requirement is 14,500, and I had a loss of 5,000, so I gave 15,000 as advance. They deducted 5,000 at the end of the day or during the trading period, and left is 1,000. Now, as I told you, the concept of maintenance margin. Let's say the maintenance margin is 80%. In that situation, what will the 80% of this thing? Tell me. It is around 12,000 rupee, because your balance went below. Yes, it's 12,000. Great. So what happens is your account balance went below 12,000. So only balance is 10,000. As the balance goes below 12,000, you get a margin call. If you deposit the money, your account is up and running. Else, you are given back your remaining amount. It's credited to your account and you're out of the trading. So on 2nd January, if price goes 1,000 below, you are almost out of the trading, because let's say if you're not depositing the margin. So it is advised to people that normally keep some extra margin into your account, or at least define your stop loss levels. Okay, what is the stop loss level? I understand later on, but first you should understand that if you have some extra margin to your account, your position will be not spared off due to the low maintenance margin level. Now consider a second situation. Consider a second situation where on the first, 2nd January, the price actually didn't go down. The price went up. So let's say price went to 31,000. In that situation, the total value will be 1550 for 5 kgs, and the margin required will be 15,500. Now actually you made a profit of 1,000 per kg, so 5,000 will be credited into your account, whereas 500 rupees will be taken from your account for the margin to maintain the 10% margin level. So net balance will be into your account, that will be 4,500. Now this 4,500 in your account will be transferred to your trading account. If you want to withdraw this account into your bank account, you can withdraw this and you can enjoy the money. Okay, let's say on 3rd January, again if the price went to 32,000, 5 kgs, total value will be 160,000. Okay, so the margin required will be 16,000. You again get how much? 5,000 minus 500 for this extra balance. So you get around total 9,000, 4,500 here. So what happens is if we add this 16,000 and 9,000, it comes to 25k. So this is how much? Just think. This is 3,000 price. You entered here. The market is 32,000, 2,000 profit into 5. That means 10,000. So 10,000 is the profit and 25,000 was your initial margin deposit. So in total that becomes 25,000. Same is here. If we add 16,000 plus 9,000 is 25,000. So what is happening in this marking to market calculation is, it's very simple. Every day profit is credited to your account and everyday loss is taken back from your account, is debited. And if you don't have the balance in your trading account, you are given a margin call, and if you fail to deposit, then your position is squared off and your balance is given back to you. Now I'll tell you, when I was trading in Forex, most of the time it's quite possible that your position is out, is closed due to lack of margin. Okay, other than your analysis may be right. It's perfectly fine. The market will go as per your direction. But after giving you certain pips losses, a squaring of your position, okay, stop loss will be hit, and the market will go into your analyzed direction as per your analysis. So this kind of situation is very frustrating. Now people use many tools like average true range to figure out the true range or average true range. People use, commodity channel index. Okay, people use many other tools. Okay, standard deviation, Bollinger Band. They figure out levels. Perfectly fine. Understand all these things are wrong. But what's wrong into taking less leverage? Have little, but it should be sure. Otherwise, you'll have money in your life, but you will never be, you will never enjoy that money. See, having money in your life is not important. What is important is that you could enjoy every penny of it. Okay, let's say you are having a balance of, let's say, $1 million into your account. You do a business, but the business is so risky. Any time that $1 million can wipe out in any trade. Now, what's the benefit of doing this kind of trade, where you have $1 million into your account, but you cannot enjoy that money? So it's very simple. That put only that much of money on risk which you can digest. Okay, people do not grow rich because they have, higher salaries. I tell you an example. There are two guys. One is having a salary of $50,000, per year, and another guy was having a salary of, let's say, $5 lakh per year. Now, what happens is this guy actually buys home, car. He's buying home, car, is having, more some luxurious items. And this guy is not buying all those things, but yes, this guy is saving $500 every month. What will happen? At the end of year, the second guy will end up with a lot of debt and EMIs. Okay. If he meets any kind of accidents, he'll be begging everybody else to give him some loan because he's not having cash, he's not having savings. And this guy is richer. Why? He's richer than this guy because he's having cash with him. So let's say for 12 months he's having around $6,000 as cash. Is he rich? You say no. He's spending everything. See, he's spending everything. Let's say I give you an example of assets. There are guys who do not even build assets. They go to Las Vegas, Angeles, they come to India, they go on a world tour. They spend like anything. So by spending or earning too much, you do not become rich. It's not about the key to become rich is earning too much. It's all about spending less. If you know about Warren Buffett, if you know about the Warren Buffett, I don't know his name spelling Warren. Warren Buffett basically is a very good value investor. He's still living in a very small home with very less, needs, very less needs. Actually, that helped him grow rich. The day when he was a kid, he used to sell newspapers, deliver newspaper, not sell, deliver newspaper. He used to save. And used to save and used to buy government bonds and stocks. How he became rich? When he made profits, did he spend all those monies? No, he reinvested it. He saved it. So to become rich, it's important that you do not spend too much. Save a little bit amount. Now, so we are now done with the future contract. So you understood the concept of future contract, how it is being traded. You go online, you select the contract, pay the margin amount, and we can buy and sell. The profit and loss is calculated on a daily marking-to-market basis. You buy now, you sell today, your position is closed. You buy now, you sell tomorrow, or any time before the expiry, your position is closed. Okay, then the future is priced based on a daily compounding basis, and also there are situations when futures are backwardation conditions. Sometimes futures are into Contango mode. But whatever happens during the trading, during the expiry period, on the date of expiry, before the expiry, whatever happens, doesn't matter. But on the date of expiry, the price should meet this spot. Okay, otherwise it will give you an arbitrage opportunity. Okay, understood the cash and carry model? Now, you're going to understand how we hedge using future contract. So hedge using a future contract. So how do we do it? It's very simple, very simple. So there are 2-3 kinds of hedge. One is spot to future, and another one is future to future hedging. So how do we hedge? It's very simple. Hedging means you buy one contract and you sell another contract. That is hedging. Okay, it saves you from further losses, but how the hedging will give you profit? I'll give you an example. I have an uncle. His name is his maternal uncle, Sohan Lal Agarwal. Okay, Sohan Lal Agarwal. He used to trade in turmeric. I don't remember what exactly happened, but I have the idea what happened that time. So let's say the turmeric was priced INR 1000 per kg. Okay, and this is the wholesale price. This is the wholesale price. In retail, he used to sell that for around INR 1200 per kg. So he used to enjoy a profit margin of 20%. So whatever is the wholesale rate, doesn't matter. He used to put 20% profit over that and used to sell. Everybody was doing the same thing. It was the common practice. One day he heard that quite possible the price will go down. And he thought, let's see, if it goes down, I'll sell it after 1 month later when the price comes up. But unfortunately, the price went down. It went down to around 600 per kg. And he had a loss of around 800,000, INR 800,000, around 8 lakh. And then his brother also suffered the same thing, around 14 lakh or 1400,000. So in that situation, he could have saved his losses and he could have gained that much of profit by simply hedging his contract on a commodity exchange. So what he could have done is, when he got the news that quite possible the price will go down, what he'll do is he actually bought in the wholesale market. What he has to do is he will sell over the MCX. So what he'll do is he'll sell at the MCX, same turmeric contract. Let's say at INR, the price might be 1000. Let's consider, for the sake of understanding, the price was 1000. Okay, let's say 1020, 1010. Let's say consider 1010, 20, little more. Okay, then this spot. We know the future price a little more. So let's say it's around 1020. So he sold here. Okay, at 1020, and he bought at 1000. So let's say condition 1 the spot price went to, actually as he thought, at 800. Now, so what will happen? The spot went to 800 at the time of the future will also go to 800. So the spot will give you a loss of how much? A loss of 200. Why? Because you bought at 1000. Whereas the future, you sold actually 1020, it will give you a profit of 1020. So what happens is you get a 20 rupee profit. However, this is not the only profit you have. What did I tell you? He used to sell at 22% profit. Okay, whatever the market price is. Okay, so he used to sell at 20 rupee percent profit on the wholesale price. So the wholesale price was how much? 800. So he sold actually at a 20% higher than the wholesale price. So he actually was selling at 960. So 160 was his profit from the 20% profit on the spot price. So total profit is 120. Now, so in whatever happens to the market is making 20% profit. Why? Because it is hedged. The loss from spot market is compensated by the profit from the future market. Now let's take condition 2. The spot price actually increased to 1200 and the future will also go to obviously 1200. Now in this situation the spot will give you a profit of 200 plus 200 profit of the extra margin you get on the wholesale price 240, which I calculated here. 160, I'm just adding it here only. So 20% over the wholesale price. And this future contract will actually give you a loss of 180. Why? Because you sold at 1020. So in this situation, you have a profit again, a profit of around 260. So wherever the market goes, up or down, you're making profit. So my uncle might have saved himself from the loss if he would have hedged his position over the exchange. Okay, this could have saved him a lot. Okay, so this is what as spot to future hedge. Now, the next thing is how do we do hedging on something like future to future. Now, or before that, I'll give you a hedging example for spot to future on the stocks. So what happens is, let's say there is a stock of Infi, that's Infosys. So Infosys is trading at, let's say, 2,000 per share, and you hold it for 1 month, and then you see the price went to 2,100 after a month. So let's say you bought it on 1st January, the underlying shares, and on, let's say, 1st February, the share was trading as 2,100. Now you believe that the price may go down. So what happens is you have two options. Either you sell your position, square off, come out, or you simply, sell a future contract to hedge your position. Now what will happen, let's say if I decide on 1st February, so this is a spot, on 1st February, let's say I decide to short a future contract. So future contract was, let's say, trading on 2120. Let's say consider. So what I do is I'll sell this thing. What will happen? Same. My profit is locked. Wherever the market go, I'll have this 100 rupees profit. Just check out condition 1. Market goes to, spot goes to 4,000 in a month. Extreme condition. It will never happen, but let's say. And what will happen to the future? It will also be at 4,000. So the spot will give you how much profit? Spot will give you a profit of, from, let's say, 2,000, it gave you a profit of 2,000. Okay, whereas the this future will give you a loss. Loss was how much? From 2,100 to 4,000 give you a loss of 1,900. So ultimately you make a profit of 120. So in fact, future you sold at 2120, so it's not 1,900. I'm sorry, this 1,880. So you make a profit of 120. And condition 2, let the spot goes to, let's say, 1,500 down. So what will happen? The future will also go to 1,500. Now in this situation, what will happen? The spot will give you a loss of 500, whereas the future will give you a profit. A profit of how much? 620. So ultimately, your profit is 120. So wherever the market goes, your 120 profit is locked. This 20 rupees is basically the interest cost over the future contract, which the 100 is the difference. So hedging normally helps. Many times it helps. Okay, hedging helps you, and when you are